Welcome to Ask an Advisor. To this week's show, Wes Moss.
Hey, Krista DiBiase.
You're supposed to be headed off right now to a place you're now not going to, right? For your kids' spring
There's
break?
so much chaos in the world. We were supposed to be on a flight to Puerto Vallarta.
Oof.
And the plane before us got turned around mid-air. Can you imagine?
Oh, my gosh.
So you're flying from Atlanta to Mexico, and halfway there, they turn around the plane.
Yeah, they
and
did
then
that
the rest
last.
have been, and then there's been a bunch of cancellations ever since. So
Yeah.
talk about a last minute scramble on what to do next. But
Yeah. Well, sometimes you have to cancel. Did you get your money back?
I haven't used an agent for a whole lot of trips, but I did for this one because I tried to do it on my own and it was complicated to figure out, and there were a lot of moving parts. So I used an agent that I've known for a long time, did a trip for us. I think it was for my wife's 30th birthday. So it was a long time ago. We went to Italy. It was a long time ago. And I'm really glad I did. A, it made the whole experience and planning a lot easier. And B, the very day we had to cancel. So the very day we got our money back.
Wow,
For the hotel, which and then I know a lot of other families are still struggling with that, haven't heard back, don't know if they're going to get money back, looking at the contract, what counts as a cancellation. We got lucky.
Well, for sure. All right.
Clark would be proud.
Clark would be proud. You could have used him to help plan it, but you would have been probably not as happy with the accommodation.
Maybe that is the case. That is maybe true.
So today on this episode, the good old standard dollar cost averaging. You're going to talk about that, right?
I'm going to talk about this. Dollar cost average for the win. Mm-hmm. Why it works so well, and really maybe the downside to it too. It's not always the best way to do it, but it's really important to think through.
And then you might be listening and feeling like, wow, all these people have been saving for so long. Some of the questions we get, what if I haven't saved enough and I'm feeling pinched and under the gun? Is it too late?
And look, this is most of America is way behind on the savings curve. And it is interesting. We do get questions here on the Clark Howard Show, Ask an Advisor, about net worth and how much the average person has saved. And there are constantly stories in the media about the median number of what people have saved, the average number, but it is never too late. What I have learned, and I've seen it in real life many times, it's not easy to do, but it is never too late it's almost never too late to start. And I also think it's never too late to be a happy retiree. And I'll talk about some of those numbers. Awesome.
And we'll get to your questions as well. If you have a question, you can go to clark.com/ask and let us know if it's for Wes or for Clark.
So think about this. I think about the springtime, and I go to Michigan. I try to spend some time. My wife's family's from Michigan, so we've gone there every summer forever, for over 20 years. And even in the summer, when it's, let's say, June or July, the water still has not warmed up. Mm-hmm. So I think of myself standing at the edge of there's a cool dog park where we go, and it leads into Lake Michigan, and or you can kind of just jump in all at once. And I always think about, you know that it may be warm, but you don't know fully the temperature of the water, so you don't know whether you're just going to wade in or you're going to jump in. And that goes through my mind when we're thinking about those approaches to get in the lake when it comes to investing. And do I wade into the water or do I cannonball into the water? There are two approaches. Either way you get into the water. Either way you get invested, whether you're dollar cost averaging in or you just do it all at once. One, the cannonball approach is the rip the Band-Aid off. And there's a lot of pain or a lot of uncertainty right out of the gate, and then it's over. And then you adjust and you're good. You're kind of on the journey. The waiting, which we've all probably waited as well, it is a much longer process. It takes you a couple of minutes. You slowly suffer from the cold water adjustment. But eventually you're in and you've gotten to the same place. And I think it's the same way when you're thinking about money. Do you invest money all at once? Or do you systematically do it over time? When it comes to dollar cost averaging or thinking about putting it doesn't matter the amount of money. It could be $10,000, it could be $1 million over the course of time, spread out over 6 months, 12 months, or even longer. First, I think it's good to remember most Americans are already DCA. Because most Americans, if you have a 401k plan and you're contributing, God willing, you are already dollar cost averaging. You're doing a little bit every single month. And it's one of the reasons that 401ks and retirement accounts at work so well. Because psychologically, it's a little easier to be dollar cost averaging your way in.
That's how millionaires are made, right? Most of them.
So market's up, you're investing. Market's down, you're investing. Sideways and boring, you're still investing. And it's a wonderful way to limit the dramatic nature of putting your money to work, knowing that it can be up or down. And that's the hard part about investing, is worrying about it being down. So in that case, it seems to be really easy. It's like, oh, I get a portion of a paycheck, it's going in every. But when it comes to a lump sum, that's when our psychology changes. And maybe it's an inheritance or a business sale or a big bonus. And then you have cash now sitting on the sideline. Well, so what gets us invested? Think of it this way. The cannonball approach, when it comes to investing, historically wins. Because markets tend to go up over time, you are 2/3 of the time, so more than half of the time, historically, you are better off having just cannonballed in. You get a $100,000 bonus or inheritance, and you're thinking, oh, should I dollar cost average this in? The cannonball approach actually does better most of the time. But it's a little harder to do. And part of this is that we end up with what I think of it as a psychologically mismatched timeline issue or crisis. Because if you've been saving in your 401k for 10 years or 20 years, you may have $200,000 already invested, or $300 or $500 or $1 million, and you're okay with that. But now that you've got this new money, and I've got this now $100,000 to make a purchase in markets over time, it creates this new psychological timeline mismatch when really you're already invested. So why wouldn't you just continue? Right.
But if you cannonball, you're like, and then you have a market drop the next day, it just makes you feel sick to your stomach, right?
Maybe, but what if you're already
But over time,
invested?
it'll be okay.
But what if you're already invested,
Yeah.
right? So how do you, from a behavioral investing, and so much of investing is about our behavior and our psychology. We can look back at historically and says, oh, well, the cannonball approach works better most of the time. It still doesn't feel like it's the right thing to do. So I think of this, and I think of the silly putty analogy, is that you start with your timeline, and it's just this timeline, and it's a 1 year or short-term horizon. And we can take the silly putty and we can stretch it out. And that's really what we want to do mentally with our time horizon when it comes to any time we're investing. It's that we get money quickly. We, for some reason, think it's got a short horizon. We've got to teach ourselves to then stretch that out and say, well, I've got a long horizon for all my other money. Well, this should be the same thing here on a newfound chunk of money. So we stretch out that silly putty. We stretch out our timeline. And I think that really helps. On the other hand, Krista, waiting can make sense because it reduces your regret risk. It keeps you moving. At least it keeps you doing something. And I think it solves the psychologically mismatched timeline crisis. So to me, they both work. I think it's this goes back to one of my core principles when it comes to investing, which is participation over perfection. We think about, it would be so nice to always be putting new money to work when the market is down 10 or 20%. That's the perfect way to do it. The reality is, first of all, that's impossible to do over and over and over again perfectly. And really, where we see people really build wealth, it's not about being perfect. It's about participating and getting money to work and being invested for 5 and 10 and 20 and 30 years over time. And that's really what wins. So cannonball works better historically, but the DCA or weighed in approach when it comes to putting new money to work is perfectly fine with me because at least it gets us participating.
All right, we are going to go to your questions now. This one came in from Cody in Georgia. I recently received a small inheritance of about $85,000, and I'm trying to figure out what the wise thing is to do with the money. I have no debt except the house, and I've already put 15% of our household income into retirement. This amount is enough for me to pay off my house, but I have a historically low interest rate, so I'm not sure that's the best option. I could invest in a rental property, but now it's not the best time to find good deals, and I'm also a little nervous about investing in the stock market with a big chunk rather than dollar cost averaging. Any advice would be greatly appreciated.
Did Cody give us how much is left on the house? Does he say how much debt was on the house?
No, it just says that this could pay it off.
It could pay it off. Okay. And look, Cody, you've got this really low mortgage rate, and that would inform you to say, look, if you're making 6 or 8% in the market, do you really want to pay off a 3% mortgage? However, and you're suffering from what we all suffer with as investors, which is the worry of the everything highs issue. Stock market's high, real estate prices are high. That means it's hard to buy rental property. It is one of those periods of time where it doesn't feel great to be investing anywhere. Does it ever feel great, Krista? When the market's down 20%, people think it's going down 40%. So that doesn't feel good either. So it never really feels like a great time to get going. But there is a lot of power, Cody, on not having a mortgage. It is one of the key fundamental. I think of the happy retire in America, the happy retiree in America, and the retire sooner method that I think through every time I help someone plan. And the retire sooner method, one of the big pieces of it is the financial side, getting to these financial green zones. One of those green zones, Cody, is no mortgage. So even though you've got this super low rate, there is something very powerful about getting rid of the mortgage. So yeah, you're avoiding a 3.2% interest rate, which is not that high. And yes, you should be making more in the market than that 5% over time. But the psychological benefits in my opinion, outweigh. Plus, we don't know what the market's going to do over the next year or two. We don't know what rental prices are going to do. So my gut is that, and particularly if you use this math, if you can pay this new $85,000 that came in, it's a complete no-brainer. If it's a third or less of your after-tax money you could utilize to get rid of the mortgage, then I'd say anybody should do that all day long, every day.
And then you could take your mortgage payment and invest that in the market with dollar cost averaging.
Absolutely. If in your case it's half the money or even a bigger chunk of the money, as long as you have other after-tax money, then I think you're still fine. But I lean towards, Cody, using that inheritance to get rid of the mortgage. I don't know. I have never had one person come back to me and say, Wes, I wish I had not paid off that mortgage.
Yeah. Okay, Greg in California says, hi, Wes. You recently talked about a calculator and indicated it was applicable to early retirees. If I am an early retiree, I'll have zero income. What am I supposed to put in the income box? I seriously doubt I'd be eligible for subsidies with nearly $3 million in my accounts, and there's no box for assets, but I don't know what my income should be for the calculator. I searched around and could not find a calculator that asks for your assets. Can you guide us on how this calculator applies to early retirees, and do you know of one that includes the assets? By the way, I don't plan on pulling from my retirement accounts until after I reach full retirement. I would live off of my brokerage accounts and cash.
Okay, Greg, I think he's talking about we were talking about the income calculator in an earlier episode on healthcare.
Yes.
Subsidies. The Kaiser, or maybe the Kaiser Family, KFF. So when you're looking at what kind of supplement you should get or get or not when it comes to healthcare, one thing matters. It's your income. It actually is not your assets. It has nothing to do with your assets. Now, your assets, if they're producing taxable income, then that counts. But hypothetical situation, $3 million in a retirement account, no money in an after-tax account, and you haven't started Social Security and you haven't started a pension, what do you put down in the income box when the calculator is looking to say, well, I need your income so I can see if you get a supplement or not? The answer is zero, Greg. You have no social, no wage income, no taxable dividends, and everything's in an IRA, and you're way before the RMD age. Your income is zero, and that is it's actually it's a good example of managing what your taxes are. It's not just about your assets. It's about how you're managing those assets. So from everything I know when it comes to those healthcare supplements from healthcare.gov, doesn't matter what your assets are. It matters what your income is. And if you're not producing any wages or taxable distributions and you're not taking money out of an IRA, income is zero.
Okay. Kyle in Georgia says, I'm 39 years old and married with 3 children. My wife and I are both working full-time in the medical field as nurses. I've moved around multiple employers over my career to date, and as such have multiple retirement accounts. The accounts are at the following providers: Ascensus, Fidelity, Orbit, which is a North Carolina state retirement account, Voya, and both my wife and I currently are with Transamerica, our 403b Roths and 403bs. We also have a personal brokerage account and Roth IRA at Schwab. What would be your recommendation with all of these accounts? Do we consolidate all of the old accounts into an IRA at Schwab to be under one roof, or do we just let them stay where they are as each has performed significantly well?
Kyle, Ascensus, Fidelity, Orbit, Voya, Transamerica, Schwab. I think I missed one. So sounds like you have 7 different brokerage firms.
Right.
And and then you've got your work. So maybe that's the 7th one.
Yeah.
You've got your current plan. This to me is a great question, because we get financial planning. One of my big core principles of retirement planning and investing is to make things simple, as simple as you can, because it's not none of it's simple. None of it is, you've got a million options to invest in. You could be in 100 different brokerage firms and banks. You could have multiple different kinds of accounts: 401k, 403b, Roth 401k, Roth 401k, just continues on. So it's your job, Kyle, to for yourself, make it as simple as it can be. Not to mention, you don't want to lose track of one of these. So yes, I'm a big believer in, particularly if you have this many brokerage firms, just pick one and have an IRA there. And as long as you can do a tax-free rollover into one area that is better than, let's say, the old plans, and let's say it's cheaper, you have more options, which is very likely true if you're leaving behind some old retirement plans, and you've got to do that analysis too. But even if it were equal in a Fidelity or Schwab, you'd want to consolidate to one just so you can have your eye on the ball. So yes, I would be a believer that the consolidation into as few retirement accounts as you can do, the better.
Okay, we're going to take a quick break and we'll come back with more of your questions, and you're going to talk about why it's never too late to be a happy retiree.
That's right. Welcome back to Ask an Advisor. I'm Wes Moss here on the Clark Howard Show. Krista DiBiase here joining me, hosting as well. And we're talking about it, that it's never too late to be a happy retiree.
Yeah.
Never too late to start saving.
Panicked right now listening, thinking, I don't have enough. They hear these big numbers from some of the people who write in, and not everyone has done that. And so what do you do? Well,
and here's another story that grabbed my attention. It was a new study that came out. Here's the headline, which is an alarming headline. It says the average American has less than $1,000 saved for retirement. Whoa, that got my attention. Mm-hmm. And here's the important point. That is true. That is a real number. The average American has less than $1,000 saved in retirement. But there's also some math involved that makes it misleading.
Okay.
So it is misleading, but guess what? Again, it is true. So it's not wrong. It's just I'd say somewhat misleading, but it also tells a real story of what's happening in America. That $955 comes from looking at a median retirement savings for all workers in America from age 21 to 64. And the way median works is that we line everybody up in a line and you pick the middle point. It's not the average. It's not the mean. Mean and average is different. Median is the middle point. So yes, you can say, hey, yeah, that's the average American. And the middle person in that line of everyone from that age range is $955. Now, the reason it is so low is that there's a huge part of that line that has zero. And you've got to count all those zeros until you get to somebody who has $1 and then $2 and you get up to $955. So a lot of people don't have anything at all saved. If you just look at the numbers and say, for those who do have something saved, so we're not starting with everyone with a zero, but if you have at least $1 saved, the median jumps dramatically, but it's $40,000. And you've got young people that haven't started saving. They haven't had a lot of time. These are people in their early 20s. So the median, if you look at anyone who does have at least some savings, is 40,000. So that's a slightly better picture. You switch from median to average, where we're just taking the average of this group. It's a different way to look at the math. Then it goes to $93,000. So now we're starting to a little bit more of an encouraging picture. And among workers who have at least some retirement savings, so you're not counting people with zero, the average climbs closer to $179,000. Now we're making some progress. So yes, under $1,000, that headline, it's technically correct, but it's also incomplete. Now, but there is some real truth to it, which is there are a lot of people who haven't gotten started. And I think about, I call them late start Larry and Lisa. Semi-based on a true story here, and I've seen this happen over time. They're 52. Their kids are now just out of the house. And they had an expense. They're raising a bunch of kids, and that's super expensive, and they had to get them through college. And for decades, that all of their money went to raising a family, like a lot of Americans. And they didn't really have much to put away. They certainly weren't aggressive savers. They're 52 and they have $50,000. Okay. Is it too late? They're in their 50s. Is it too late for them to save it for retirement? And the answer is it's not, because in 2026, if you're under 50, now you can save $24,500 in a 401k. If you're 50 plus, add another $8,000. Now you're at $32,500. That's a lot of money. They're both working. So you've got 32, 5 times 2, that's $65,000 combined 401k. Now let's assume they save another $10,000 in a brokerage account. Now you're at $75,000 a year. I know that's a ton of savings, but they're also earning more than they've ever earned because they've been working now for 30 years. Take that 75 a year at a 7% rate of return. And by the time they're 65, that's a million, close to $1.4 million. So all of a sudden, they're going to go from very little saved, if they were to do this for a full decade at a 7% rate of return. Actually, no, it's not. It's more than a full decade. Getting to 65, which is still not that's still a relatively normal age to be able to retire. They can get to $1.4 million, $1.5 million, depending on how markets do. And that is, so it's not too late for late start Larry and late start Lisa. Now imagine you start doing this a little earlier, and imagine you start doing this at 40. Now you're looking at a lower amount you're able to save in the 401k max. It's 24.5, but if you did that at a 7% return, then in about 19 or 20 years, you would end up in the 7-figure range. So you'd get to $1 million by the time you are, call it 59 or 60, even with a lower contribution limit. Remember, $24,500 relative to what they're doing at $75,000 a year. So the math can work. It's just going to take some time. Now, here's the other thing. If you look back over the last 15 years, the market's been really strong. The average annual return, or average rate of return for the S&P 500 is around 12%. So if you'd been just one person at $24,500 for 15 years and got 12%, you'd be at $1 million. So the Larry and Lisa together now can save a bunch. They can go from very little to $1.5 million by the time they're 65. And a single investor at 24.5 at a 7% rate of return gets to $1 million in about 19 years. If you had have the tailwind of a market like we have had, doesn't mean it's going to continue at 12% a year. You would have gotten there in about 15 years. So it's never too late. We've talked about this a little bit here on today's episode. It is about participation over perfection. Yeah, it'd be great if we had 12% a year. It also works pretty well at 7% a year. It's about participating over a decade plus. Late start Larry and Lisa can still turn it around. Save, but saving's not enough. It's got to be invested. So saving first, investing too, and then think about those future income streams like social that'll add to their investment withdrawal over time. Seen a lot of folks, very little in their early 50s, plenty of money to retire in their mid 60s.
Okay, well, this was not from Late Start Lisa, but this is from Lisa in California. She did not get a late start. She said, the majority of my retirement savings is in a Schwab traditional 401k with no company match. I have 2 additional Schwab accounts, a personal brokerage and a Roth IRA. Our work 401k plan has just been modified, allowing the option of my 2026 401k deferrals to go into a Roth. I'm 60 years old, earning $114,000 per year, and plan to retire in the next 18 months. With only a short time left to make my 2016 contributions to my Roth, should I bother? My 2026, I don't know if I said that. Should I bother? Or should I just continue to make the pre-tax, keep in mind I live in a high tax income tax state, traditional contributions? I feel like starting so late in the game with the work Roth contributions that the waters will just be muddied with both types of contributions. What do you think?
Lisa, that's an interesting way to think about it. You've got a couple different accounts and you've got, wait a minute, I have this regular 401k, maybe that gets rolled to an IRA, and then you have a brokerage account, and then, or 2 brokerage accounts, and then you have a Roth. Does that muddy the waters? In practicality, not at all. Because when I'm thinking about, when someone says to me, I need $50,000 out of my accounts to build a sunroom, as an example, it gives you optionality and it doesn't make it more complicated. It takes a little more thinking of where we should pull money from, but the Roth gives you that optionality to say, you know, I don't want to take $50,000 from the IRA because it's going to increase my taxes. And my brokerage accounts have a whole bunch of unrealized gains. I don't want to sell stock. So maybe the Roth in that particular moment could be the account you pull from. It's really, I think of it, when you're doing distributions, you're just looking at the menu of your options, brokerage, Roth, traditional, and you want to pick both for the short term today and the long term, what's the most tax efficient way or account to pull from. So I don't think that it confuses you. It'll actually give you optionality, tax optionality, which is what you want in retirement, Lisa. And because you are in a high tax state, at 114 a year, you're probably right around the 24 marginal bracket if you're single here. And my rule of thumb on Roth 401k versus traditional, $24,000 bracket or lower, you want Roth 401k. If you're above that, and you're let's say you're in the 32 bracket or 35, then you maybe want to continue to weigh or lean traditional 401k. But I think you're in the spot where the Roth 401k may make the most sense. And I wouldn't worry that you're 60 because you're going to be getting to choose to use that money over the, hopefully, God willing, the next several decades.
Okay. Wayne in Illinois sent this one in. My husband's mother's financial advisor has been talking about something called covered call income ETFs and has been recommending them for her because they supposedly pay out a sizable income so that she wouldn't have to flat out sell her investments as she draws funds for her own retirement. As we're nearing our own retirement, we are wondering what you think about these and if they ever make sense in one's portfolio. Because they pay income, can they ever make sense to complement or even substitute the bond portion of our portfolio? Thanks.
Wayne, these are anything that's covered calls. Think of that as a basket of stocks. And with those stocks, the manager, these are managed, by the way, like a mutual, think of it like a mutual fund, but now we have managed ETFs as well. What's happening is that the managers are selling calls on the individual stocks that are within that portfolio, and that income, that option income, gets paid out to you after their expenses, et cetera. And you'll see a lot of these covered call ETFs paying out 7, 8, even 9%. So you think to yourself, wow, that sounds awesome as a replacement for bonds. The reality is they are not a replacement for bonds. It doesn't mean, though, they're not a good idea. I do like these covered call strategies. I like them when they're really diversified within the ETF, so a lot of different equity positions. They're bringing in option premium by selling calls, so you get some cash in. But what does that do? It limits your upside of the stocks. So if you look at a lot of these covered call ETFs relative to the market, let's say the market's over the last 5 years up 90%. Your covered call ETF may be up 50 or 60%. That's counting the income. That's counting the option premium that you're receiving. So not a substitute for bonds. So they're more aggressive, or let's say they're, quote, riskier than bonds, but they should be slightly less risky than an all stock portfolio. It dampens the volatility. You get more income, but you're also trading at your upside by virtue of selling these calls, which are options. And I think that they are very much can be a part of a diversified what I would consider, and I like it to do it this way, multi-asset class income portfolio for retirement.
Okay. Corey in Minnesota says, I'm 40 years old and well on track to retire early, but I plan on working another 15 to 20 years. When it comes to investment strategy, I'm very aggressive. 100% of my retirement accounts are in broad index funds like the S&P 500 index and total stock market index. I know I'm already well diversified, but I wonder if I would benefit from having some of my money in other things like commodities or real estate. Would I benefit from this additional diversification, or am I already sufficiently diversified with just the stock funds?
Corey, you're 40 and you're pretty much 100% stocks, but you still have a 15 to 20 year time horizon. And I think that's totally appropriate if you can handle the ups and downs of the market, which it sounds like you can. 100%, there's nothing wrong with a 100% stock portfolio because total market indices will give you great diversification. What you're asking about is the next layer of diversification, or the cousin to diversification, which is asset allocation. You've got really one asset class, probably U.S. stocks. That's great. But if you are now going to start thinking about asset allocation, you would be adding small cap stocks and mid cap stocks and international stocks and commodities and real estate and some of these other areas, maybe not bonds yet because you're still too young to do that. But there are a lot of other pieces of the equation or that you could add to your pie to give you many different asset classes. And I do like that over time. Now, that goes from diversification to even more diversification, which is asset allocation. And you may say to me, Wes, sometimes isn't there something called diversification? And the answer is, from a total rate of return standpoint, let's just say stocks, U.S. large cap stocks over the next 10 years, they are the best performing asset class relative to gold, commodities, alternative income, bonds, international, et cetera, private equity. So anything you do that's not U.S. large cap stocks in a portfolio would technically bring down your assumed rate of return, right? If stocks averaged 15 and just one slice of the pie averaged 5, then your total return might be 14 or 13 or 12. And then you look around and you say, well, isn't that just diversification?
Oh my gosh, financial advisor humor. I love it.
I don't even know if that is humor.
I like it. It made me laugh.
It is the thought of, hey, I've got all this diversification, but really just made my returns worse. Think of asset allocation, though, not just about your maxing out your rate of return. It is creating a portfolio, Corey, that you can really be comfortable with, that helps the behavioral side of investing. It helps you keep participating, which has kind of been a little bit of a theme here today.
Yes.
In the long marathon that is investing. And particularly as you get older, and very much so once you get into retirement or the distribution phase when you're pulling money out of these accounts, I think it does make sense to start thinking about adding some of these other areas and do that over the next many years, because I'm a big believer that the benefits of asset allocation, and to me, the psychological benefits of having a multi-pillared foundation as opposed to one, really, really helps over the long run. So yes, I would be thinking about starting to add some things over time.
Okay. Participating by listening and watching this podcast, you are participating in your financial future, and we appreciate it so much. That's it for us this week on Ask an Advisor. We'll be back next week with a fresh episode for you, and Clark will be back tomorrow. Please share this with a friend if you learned something today. We really appreciate every single one of you that tunes in and watches and listens.
Thank you.